You don't need to change your job, you need to change your business. So this video is ideal for IFAs and mortgage advisors who are currently self-employed, have their own client bank and are typically left by the business or network to do the advice to clients how they see fit within compliance guidelines. So what I mean by that phrase, you don't need to change your job, you need to change your business, is we're getting an increasing number of inquiries come to us where they're seeing issues in their business, and actually their core job will stay the same throughout. So going out to see clients on the ongoing review basis, trying to generate new clients as well, that all stays the same. But there's changes in the business that will make them happier and more aligned to what they're looking for. So I wanted to share some examples which include an individual who's not happy with the robustness of the firm they're with. So they're really concerned that if the FCA come knocking on the door of the business, they don't think they're going to pass all the checks. And the real risk that provides as a self-employed individual is your name will be tarnished with that firm. You will be off the road for minimum 6 months, if not much longer, because how long is a piece of string with the FCA? We all know that. And it will really set you back. So they're looking at the move before the inevitable to firms that we've got that have got robust compliance, stay on top of all the new policies that the FCA keep bringing out, and even have a zero PI access for their advisors, so there's minimal cost if there are complaints. Also, an example we have are advisors who are unhappy with the technology the firms use. So that could be either they're still in a paper-based system, or even the software they use has become antiquated. It's just not providing that efficient way, which when you're out on the road, you need to be able to work at speed, work effectively without being bogged down in slow processes. Also, we've got individuals who are no longer happy with the retention rate they're paying, and they don't feel it provides value anymore. So they admit they need to pay some retention away for all the compliance and support they get, but it's become stagnated by that business in terms of the value they provide. And so they're looking to move either for a less pay away, or maybe even a similar or more pay away, but getting a much better value for themselves, but also their clients. And that might even help them uplift their fee slightly, because they can now incorporate cash flow modeling as an example, or more detailed annual reports, whatever it might be, that there's something better being offered. Also, we've got examples where the advisor no longer sees eye to eye on compliance, whether that's contingent-based charging, or the argument between fee-based and percentage-based, which one's right or wrong. I don't think there is a real answer, but they're no longer seeing eye to eye with compliance, and so they want to move to a business that is more aligned to their ethics. So there's a couple of examples there of how your job would not change, but the business you're part of would. So if that is sounding similar to you, feel free to get in touch with us, and we can see if there are other options out there, so you're not having to suffer from those headaches as well. Thank you for listening.